Good morning. It is Friday, January 22nd. Thanks for joining us. We've got a lot going on. We had a busy week, and so I want to cover a couple of things. First off, most important thing to us is right now the next FOMC meeting. The Feds are going to meet next Wednesday and Thursday, January 26, 27. And from that, we're going to get a lot of information. They'll be putting out their forecast for the year. We'll also get a reaffirmation for interest rates for the next 18 to 24 months. So that's going to be an important meeting. Some things that's developed around that meeting is up until now, we had really thought that that Chairman Powell's term, it will end in February. And Powell is a Republican, so our consensus had been that once a new administration came in, they'd be replaced. And the likely candidate was Lael Brainerd, who is an extremely intelligent economist. And so we were looking for that. But what's developed over the last couple of days is there's a possibility Biden has chosen Janet Yellen as Secretary of Treasury. Well, Janet Yellen was a former chairman of the Fed. And if her and Jerome Powell are working well together and they have a lot going on together and there's a relationship there that can be preserved, then the feeling right now is that he will probably be asked to stay on for another 4 years or another 2 years till 2022, I guess it is. And so that'll be really interesting to see what happens. That we had felt that in February there was an automatic change in the chairmanship of the Fed, but now it looks like that may not happen. So it'll be interesting to watch. And then the part to that is to be able to watch the Fed and their guidance with the chairman in place and see if that changes any. Because Powell lately has come out and said that the recovery is going better than he expects and that it's coming along quicker. So those are all positive comments, and those kind of drift down into the general population, and it does have an impact. So the new administration may choose to keep the Fed chair in place and keep that momentum going. So we'll have to see what happens from there. So let's get into this. A lot's happened. I think I've talked a couple times about some of the things we look at when we're looking at the market and the insights and things that are going on. Some of the things that we take a look at, we kind of feel like we're watching clowns balancing plates on top of sticks. And that's kind of true this week. It's been interesting. This is our Dow Jones average, and you can see we're doing a trailing 12 now. So you can see over here on the far right-hand side, we're still seeing an increase. That is going to change today. We're not going to have a good day. And part of the reason is relative to COVID for the most part, not relative to politics. You've got the UK has shut down until the end of January. Japan has closed their borders, period, until the end of January, and that may extend to January the 15th. So you see a lot of COVID issues coming up, and that's kind of what's putting the brakes on some things, and we have to be careful of that. We've also got to watch and see what the administration decides to do. First day in office, they signed a mask mandate, and that's generally across the board, and it applies to, in most cases, transportation, public meeting places, government meeting places. And we'll have to see if they decide to go any further than that. That could affect the economy, and right now, that's kind of what's affecting us today. We expect the opening to be down about 200 points or so. We'll have to see how that goes. But generally, we're still moving up. If you look back here to March, where you had the deep part of the COVID, which I think we've identified as March 23rd, we're now recovered and we're above where we were a year ago. And we'll see a number on that in just a second. So next chart, Mallory. This is our markets for trailing 12. And again, I've adjusted that a little bit. And you can see one of the things I talked about was my concern about a recession in the UK that could have some effect on us. And I can see that now developing. A lot of that's being caused by their lockdown that they have right now. But you can see that they really haven't recovered as much as everybody else has. So I have a little bit of concerns about an ongoing recession in the UK and can they pull out of it? And because this has become a global economy, I'm worried about the rolling impact of that. And we'll just have to remain kind of aware of what's happening there, that they really need to have some things go right for them. It won't happen for another couple of weeks before we see any positive movement. But this is generally how the global markets have done over the last 12 months. My warning on this is, as we reach the end of March, you're going to see these numbers on the right-hand side rocket up. And the reason is these are trailing 12 numbers. So what's going to happen is, as we get into March, we're looking at March had the big dip, and everything since that dip has been positive. So we're going to have to be aware that these numbers are going to shoot up, and we're going to have to keep pointing out that that's taken into effect that really deep drop that we saw in March. Okay, so next slide. These are the unemployment claims. We had another week where we went 900,000, a little concerning, and I'm going to show the alternate side of that in a second. So we're still fighting that battle, and we'll have to see what happens. We're at 900,000 for the last 3 weeks. The numbers will be out again next Thursday morning, and let's see if we have any improvement there. I do expect that to start affecting us. This is the trailing 12 performance for our sectors. And again, what's going to happen is as we head into February and March, we're going to have that last part, the first part where we started back in last February, March, where we had the deep drop affect us a little bit. But in general, for the trailing 12, you can see that our biggest problem has been energy and utilities. We've been talking about that for a while. And our biggest increase has been, take a look, you've got telecommunications, which there's some reasons for that, obviously COVID related, and then consumer goods, which has done very well. And again, we're gonna see a reason for that in just a second, which is kind of exciting. Next one, Nara. And this is our volatility index. Now, the thing to watch about this is, can we remain down here around the 20s? Obviously, I'd like to see it at 10 to 12 to 15 maybe, but I'm gonna take it if we can stay at 20, 21, 22, then I think we're gonna be okay. And as long as that moving average, which is the blue in the 14-day, as long as that stays down where it is about 21.5, then I think we're probably going to be okay for a bit. But we're paying attention to this because as this goes, so goes the market. If you look back here early March, we saw the volatility go up, and about 3 weeks later, that's when you start seeing those huge market declines. So the volatility index does have some relativity to what we see in the market. So we're going to be keeping an eye on that. But right now, we're okay. This is the incredibly bright spot right now. I have no idea. I can't look back and see, have we ever seen housing starts do what they're doing right now? A lot of this is the interest rates. When you can get a 30-year mortgage for 2%, that's extremely attractive. But right now, we went in December and our housing starts are still going up. Remember, I'd said October they would go up. I've always said April and October are big months. And here we are, December housing starts really shot up. So it'll be interesting to see how long this keeps going. My concern here, well, I'm really happy to see this. I think this is great. I want to stay above that that red dotted line. That's 1.2 million starts, roughly, a little bit short of that. I want to stay above that dotted line. And so if we are, I'm pretty happy about it. My concern is that we may be in a bubble that's going to last until about the middle of 22. And that's when interest rates start going back up, supposedly. If they do, then you could see housing starts kind of get the brake put on and see what happens. But this goes back to my consumer goods number that we saw a few minutes ago. That's part of the reason for that rise in consumer goods. You got a lot of new houses going up. You got a lot of people moving, and that's going to drive that a little bit. The other thing that'll drive to some point is financials. But as long as those interest rates are at 2%, that's going to be just a little bit difficult to do a whole lot there. But there is a lot going on. So housing starts are good news. These are my forecasts that I put these out the 1st of January. I'm kind of going to stick with these right now. These are not real optimistic, but they're optimistic. Right now, unemployment, I've got July, I think we'll be at 6.2. That's kind of a safe bet. We're at 6.7 right now. I think the challenge is going to be getting from 6.2 to 5.5 by the end of the year. And again, if we can get through COVID protocols, I think we'll be okay. The Dow right now, I'm saying 33,000. We're at 31.1 right now, 31,175. We'll end up today below 31,000. So that's not a ton that it has to make up. It's about 6.5% for the end of the year. I think that's easy. The S&P 500 is a little bit more of a challenge. It's especially a challenge because Apple is such a big piece of that. And then you've got NASDAQ. I'm asking for 15,000. We're at 13.5. So that's not an enormous growth, but it's a solid 10, 12%. And again, our biggest players are companies like Tesla, and they're kind of overweighted, and that's going to affect it. That's why I backed off of those numbers a little bit. So those are our forecasts for 2020. We'll keep it there. If I change it, it would be probably toward the end of the first quarter where I might make an adjustment. So what are we headed for? We're headed for FOMC January 26, 27. They won't have a meeting in February, and they will have another meeting in March. We'll learn about the presidency and the chairmanship of the FOMC probably about the February 10th to the 14th timeframe. That's when I expect it, unless the decision's made ahead of time, and that's certainly possible. And they may want to make that decision just to calm down the market and keep things stable, because that is a stabilizing effect. The fact that you've got a chair in, whether it is a continuance of the current one or a new one, the fact that it's in will kind of stabilize things. So we're watching for that. We're watching what the FOMC puts out on January. It'll be about January 30th. We'll look through their notes, and then we'll come back to you and tell you what their prediction is for interest rates and what their prediction is for the market. Though I don't expect that to change a lot. Their interest rate forecasts are 0 or near 0 for the next 18 to 24 months. The big thing there is going to be what they say about GDP and where that's going to go. Whether we are officially or not officially in a recession is based on their comments on GDP and where we are. So that's going to be really important what we hear in about 8 to 10 days. And then what happens basically is we have stability now in administration. So that's all settled and that's over with. We can go on to the next page. And then things start to settle down once the FOMC is over. And our only issue, our concern, our cause is COVID and how we manage that. Can we get rid of it? And again, as I said, we've got the UK is shut down, Japan is shut down, and to see if those inclinations to close the borders spread, and that could affect the economy a little bit, the overall economy. For us, we're keeping where we are. We did raise our energy and oil, as I said we would. We didn't raise it a lot, but we raised our focus just a little bit. We did cut back on information technology, again, just a little, not a whole lot, but we cut back a little bit because we see a lot of these tech companies may have probably had their heyday in the last 9 to 10 months. So we have made some of those changes. If you have any questions, please give us a call. We're here for you. If you have some friends who would like some interest, tell them to 15 minutes on Friday mornings, a pretty cheap investment to come on, tune on in. We're on Facebook. We appreciate comments and questions, appreciate phone calls. So get back with us. We will see you again 1 week from today. And we'll be at the end of January already and well into 2021. And we'll go from there. So thanks for joining us. We appreciate seeing everybody every week, and have a great week. Stay safe. Thank you.